Hey guys, thanks for checking in. In this video, we're going to talk about space, specifically the aerospace and defense industry or sector. The reason why we're talking about this is because companies within this industry have been seeing a lot of movement on the stock market, and it's looking like we're going to continue seeing a large focus on the entire industry in the coming years. In this video, we're going to cover space, which is satellites, probes, and everything in between. We're going to talk about military spending, which includes space, and we're going to talk about why those relate. And then finally, we're also going to talk about commercial airlines and how that's projected to perform over the coming years. We're also going to dive into companies that have opportunity in this space because if there's so much spending, this spending has to go to these companies because they manufacture the satellites and the equipment and the pieces needed, avionics and everything in between. And so let's go ahead and dive right in. First, we're going to do an overview and then we're going to get into the companies. A lot of these have already ran up in valuation, but there are some names that are still trading pretty low and are looking to catch up as the cycle continues to grow in the coming years. So as you can see, this is a very vertical chart. This is not a meme coin. This is not a crypto or an altcoin or anything. This is the number of objects launched into space in recent years, and you can see there have been a massive jump since 2020, not just in the United States but across the world. The United States is contributing the most to this. However, across the world you can see that there's a lot of space activity. This coincides with global military spending. You can see that global military spending hit a record in 2024 of $2.7 trillion, and it's expected to continue growing. The United States makes up about 1 trillion of that alone. And so this kind of shows you why the United States is so ahead of everyone on this chart. China far behind, but it's kind of hard to trust what China says about their numbers. I'm sure they're much higher than that. Now, how does this relate to our investment thesis? Whenever we see large spending, this is an insane amount of spending. You can see that spending across the globe on defense has been ramping up since 2010. And the reason why is because there's a lot of geopolitical risk. A lot of infrastructure needs to be renewed. And then, of course, connectivity is turning to space rather than just land. You know, you have low orbit satellites that are starting to become very popular, and constellation of satellites that are needed in order to connect everything in our world and provide countries with their own safe communication systems rather than relying on a global communication system. And so why is this happening so suddenly? It's because going to space has never been cheaper. SpaceX is really revolutionary in the way that they made going to space and back cheaper. They're not reusing they're reusing rockets and launchers. They're not having to spend billions and billions of dollars to go to space every time. And so that is something to consider. As space travel becomes cheaper, that's when you'll start noticing more payloads going to space, companies that are private going to space. So this isn't just NASA spending this money. You have private companies and public companies now. You're probably familiar with a name like Rocket Lab that are going to space and taking things with them, things that are necessary to power communications. So now airlines, where do they play in this mix? We can't talk about aerospace and defense without talking about some airlines, although these are not going to be the main focus of our video today, because airlines, they have low margins and are very cyclical. Everything we're talking about is cyclical, but airlines are just exposed to a lot of headline, fuel prices, a lot of headwinds that are not so stable. Because with defense, the beauty of it, and it sucks to say this because there's always going to be geopolitical risk, countries are not going to cut back on defense spending. However, with commercial airlines, consumers may cut back on spending or buying vacation tickets if there's a slowdown in the economy. So airlines are going to be more susceptible to short-term cycles, economic cycles, whereas defense is going to be a little more steady. And space is a new high-growth area of the aerospace market that's expected to dominate in the coming years. So let's dive into some of these companies. Let's go ahead and start. We're going to start with Rocket Lab. So We're starting with space and satellites. Right here, here's Rocket Lab. So you can see that Rocket Lab has had a fantastic 12 months. The stock was at $14 and about 12 months ago, nearly reached $100 before getting rejected and pulling back. Where does that leave Rocket Lab now? If we dive into the company's fundamentals, we can see that the stock, we'll get into the chart in just a second, but if we dive into their fundamentals, we can see that just like the military budget and this chart is vertical, this company is growing revenue at that same vertical pace. I mean, you can see 120%, 32%, 36%, 50%, but it hasn't sustained that triple digit revenue growth, and they're not making so much money to make them a safe buy and forget type of investment. So with that being said, when the market pulls back or sees any form of uncertainty or instability like we're seeing right now, Rocket Lab is going to be more prone to higher moves to the downside. But that is also true for the upside. When momentum is restored and confidence is restored, you can see a company like Rocket Lab, which has solid revenue growth, recover quickly. But when there's uncertainty, these companies with very little revenue and a lot of uncertainty are going to suffer the most. That's why Rocket Lab was cut by about 30% within a matter of weeks. Balance sheet, small, decent. Free cash flow is negative. Their company is not profitable, and that is not unusual for a young company, especially in such an expensive industry. Expensive because it takes a lot of money to launch things into space, despite it being the cheapest it's ever been. The company is $36 billion and they're not breaking $1 billion in annual revenue. And so I think it's time for Rocket Lab to take a breather. They're not a bad company and they have proven themselves, but until they ramp up revenue to the point where it starts to justify the price point, it's going to be tough for investors to make those big bets, especially in an uncertain environment. Now, let's jump to Iridium. Let's actually talk about Rocket Lab's chart before we jump into Iridium. You can see that it's sitting right at our support of 66 to 67. It's trying to come back higher. If it fails, then it will break back below this consolidation range of late last year, and that can set it up for a further move down to 53 to 55. Perhaps consolidation here for the next few months or even few quarters before, if they can prove themselves on earnings continuing forward, there's a lot of opportunity to the upside, especially as the space race continues. Next stock is going to be Iridium. Iridium Communication is going to be one of our favorite plays right now. So this is actually a company that we covered not too long ago. What you'll notice about this chart is that you can clearly tell that it's not extended like Rocket Lab is. Rocket Lab is heavily extended. It's way close to the upside, whereas Iridium is just basing out and it's starting to move after strong earnings. You can see a lot of volume is coming in. We covered this stock in January, early January at around $19, and it's already sitting at our first price target. So we see more upside from this company because of their involvement in low Earth orbit constellations, which are the basis of creating secure communications for countries. Remember, we talked about this earlier in the video. So countries are looking for independence when it comes to communication. Iridium is trying to solve that problem, and they're one of the leaders in this space right now. Unlike Rocket Lab, this company is only $2.5 billion. Positive price to earnings ratio, so that tells us that they're actually profitable. Balance sheet also positive, and free cash flow is also positive. So ask yourself, as an investor, would you rather pay $64 billion for a company that's making about the same revenue, if not less, than this company? Or would you rather get into the popular name like Rocket Lab, which is already overextended and is worth $36 billion against this one at $2.5 billion, and this one is profitable? I'm not saying Rocket Lab is a bad company, but when it comes to positioning yourself, especially if you're looking at the entire industry and choosing between the companies, a company that is profitable, has an entirely lower market cap, and is solving a niche problem might be the better choice. So Iridium on the chart, like I said, it's already reached our first price target. We're still in this stock. Let's go ahead and let's reestablish this chart a little bit because this is a little dated from when we initially did our analysis. You can see that the stock's next resistance is around 25 to 26. We got this from right here. And then if it breaks above that, the next resistance is going to be around 29, which is also going to be around our next price target. For those of you in the group, we will be managing this trade as it moves in the coming weeks. Support is going to be right around 22. We'd like to see it maintain this breakout. Even if it pulls back a little bit, we'll give it some grace. But even if we're not so focused on the short-term charts, if you're just buying the business, Iridium seems like one to buy and hold for the coming months, especially if they continue growing earnings and they start ramping up contracts and landing new contracts. Next up, we're going to talk about LMT, NOC, and RTX. So these three companies you're probably familiar with because, of course, they are the three main defense contractors that the United States and much of our global allies use. So with LMT, we covered LMT back in December of last year, December 2025. You can see that we covered it back at 475. This price target, I mean, it blew it out of the water. But now that we're covering it months later, I mean, we already took profits on this, but now that we're covering it months later, we have to kind of figure out, now is it kind of reaching a peak? Because as much as there is defense spending, eventually a stock will reach a peak, and you can see that it's pretty vertical. And if, for example, the United States manages to solve the Russian-Ukraine problem, perhaps we're going to see defense pull back. So you have to think of the headwinds. So you're buying an expensive stock, unlike Iridium, which focuses on communications. Now we're talking about defense. So these are going to be cyclical. So if a country stops buying or stops producing rockets or doesn't need them as much, or launchers or whatever they need, then perhaps it's time for the stock to pull back. It won't always go up like a high growth stock because they depend on cycles. LMT is trading at a 30 price to earnings ratio, not bad considering the market is around 27 to 29. Market cap is about 150 billion. This obviously you can see that there has been quarterly revenue growth. It's not substantial, but it's pretty impressive for a dated company, and net income is positive, although margins are a little small. Balance sheet positive. It's you can see it's heavy on assets and it's also heavy on liabilities. It's not that sweet 2-to-1 ratio. That's not abnormal for a heavy industrial stock because they do have factories and they need to continue growing factories to meet demand. Positive free cash flow at 7 billion, pretty impressive. Not a bad company, but I will say it's not one that I would go fully into right now just because it seems a little overextended. But if you're a trader and you're only looking to trade the stock rather than buy and forget about it, what you can use are the 10 and 20-day moving averages here. You can see that this blue and purple line have been acting as a main support for the stock. As long as it holds those lines, it is still in a strong bullish trend. You would use either of these lines as a stop loss. For example, here you can see that the stock broke above those lines, rallied for months, and once it broke back below, you could have sold. So kind of same idea, but just know that you're buying pretty late into the rally. NOC, same idea here. Let's dive into their numbers first. Let's see what they're trading at. Price to earnings ratio, less than Lockheed Martin. Market cap, also less than Lockheed Martin. Balance sheet is a healthier balance sheet. You can see positive 16 billion in total equity. And growth has been about the same, which is not surprising. They do have better margins though, which explains the better price to earnings ratio. If you're looking at Northrop, also pretty late into the cycle into buying it, but that doesn't mean it'll stop going up. Remember, the US is spending $1 trillion on defense this year, including aerospace and defense projects. Northrop is a main receiver of that. You can probably still trade this stock as it's likely going to see more attention. You can also use the 10 and 20-day moving averages on this one. We're going to skip over RTX also, although that's a really good company. And I kind of want to just point out just a couple more companies that we've covered here. One of them is AMTM. The stock just pulled back on earnings, but it doesn't mean it's a bad stock to buy. AMTM is a company that we covered We covered this July of last year, and you can see that the stock has rallied to our price target. This was since July. This was our entry. It has rallied and it even hit our second price target, but pulled back on earnings. So now that it pulled back and cooled off, you can see, by the way, this is a perfect example because this looks a lot like LMT, right? This looks a lot like NOC. When you need to be forewarned. If a stock is trading really high, and then they report earnings, which is exactly what happened. That earnings, even if they're great, they already may be baked in. Maybe traders were already expecting strong earnings, and when the company delivered, it fizzled out. So people were like, okay, it's time to take profits. But it doesn't make it a bad stock. If a stock in an uptrend gaps down on earnings, it's not necessarily a reversal. It could just be a pullback opportunity. But if it's already in a downtrend and it gaps down, and it's likely continuation sell-off. But let's clear this and get into AMTM's financials. $7.5 billion company, extremely high price to earnings ratio, which probably means they're profitable, but very low profitability. Yep, this is true. The company reported $3.25 billion in revenue, but only $44 million in net income. Young company, so it's okay. Cash flow positive, balance sheet positive. Let's see if there's a trade going on in here. So if you are looking to trade AMTM, you would want to put a support around 27 to 28, which is going to be before this gap fill. The stock can probably come back here, consolidate a little bit before going back up. You can see that this is a fairly new IPO. There's a lot of upside. Above 38 or 39, it's pretty much a blue sky breakout, which means there is no resistance at that point and going forward. So it can virtually go on forever. This is only a $7.5 billion company. If they continue ramping up revenue, which is going to be the main focus for any young company, then it's likely to continue succeeding. Now, keep in mind, this is a technology-driven service company that operates in defense, which you already know high growth is tech. Tech already sees a lot of demand, and defense is seeing a lot of demand. So if you combine these two, Amentum is at a perfect position to take advantage of this because they can be a high growth company. But they need to prove it. They didn't prove it as so on this earnings quarter. You can see that revenue actually dropped year over year, which is surprising at 5%. Remember, revenue was growing at 70, 60, 70%, but this quarter was not that impressive. Going forward, that's going to be the main talk. Earnings are not until May, and so this stock may move sideways up until then, or maybe rally into the highs before they report earnings in May. If those earnings turn out well, then the stock is likely going to see more upside because they have been growing and they will continue proving themselves. Other companies that you guys can check out, and I'm not going to cover them in this video, is OII, which is Oceaneering. It's defense and subsea mining. We've covered this video, already reached our price targets. VVX also moved to our price targets. This is a massive name in defense. And TTMI, this is a technology company that's pretty much upgrading the infrastructure of avionics, airplanes, airlines, and satellites and whatnot. So again, we covered a lot in this video. I hope this gives you an idea of where the total aerospace and defense industry is. And hopefully you got some good information and good names out of it to review for your own watch list. Thank you so much for joining, and don't forget to subscribe and like.